All right, the homeowner exclusion, classic, iconic topic for the exam. Make sure you know it. This $250,000, $500,000, super important to memorize. The homeowner exclusion, also known as Section 121, don't worry about that terminology. Just know it as the homeowner exclusion. This allows eligible taxpayers to exclude a certain amount of gain from the sale of their primary residence from being subject to tax, which that sounds good to me. Why is this? What is this? This deals with individuals, so we're not really dealing with businesses anymore. This is just me and you, individuals. Not that I'll ever own a house at this market and this rate. But anyway, that's just my problem, but it's also probably a lot of other people's problems as well. Interest rates through the roof, property costs through the roof. Oh well, all we can do is just keep studying for the CPA exam. Now, why does the IRS have this before we even get into what it is? What is the most important asset to the majority of American people or individuals or families? It's their houses. This is to encourage people to continually buy and sell houses, to hopefully inflate the housing market, to then get those properties values higher. What does the government want? The government wants happy taxpayers, and then with something such as this, it allows a facilitated, easy way to move around, buy properties, to continually save on taxes when buying properties. I'm not sounding like a conspiracy theorist. This is why this exists. The government wants asset home prices to keep going up, because then also the more prices go up, once things are sold, there's more tax income on that. Inflation's good for the government because inflated prices mean higher taxable amounts. So that's the gist of it, just to give you kind of an idea. But this is a benefit for individuals because we're not going to get slammed with taxes when we sell our primary residency. There are a lot of various rules and regulations you have to follow that we'll go through here, and you do need to memorize all of these. So first off, you only get this benefit. Now, this is a benefit if this is your primary residence. So if you've got multiple houses, you have to take a primary residence test, which essentially determines, have you spent the majority of the year in this residence? If you spent 6 months and 1 day, then you're good to go. The ownership and use test, the taxpayer must have owned and used the property as their primary residence for at least 2 years within the 5-year period ending on the sale date. We'll see lots of examples going through all of this. So again, super important. You can't have your primary residence there and then just not use it. Exclusion limits, married taxpayers can jointly exclude $500,000 of the gain, while single taxpayers, married filing separately, and head of household filers can exclude up to $250,000. This is very much, again, dealing with individual income tax. We're seeing how if you sell a house for $1 million and it was worth $300,000 to you, that's $700,000 of gain. Now, assuming you meet all the other criteria, if you're married, you can exclude $500,000 of that. So you would have only $200,000 of tax. But if you're single, you only get to subtract $250,000 from that. So it would be $1 million minus the, let's say, $300,000 of value minus another $250,000. You'd pay tax on the difference. Ownership and residence requirements for married couple. Either spouse must own the house, but both spouses must meet the residence requirement. We'll see examples where someone owns a house for a few years, they get married. So obviously that new spouse moves in and, not obviously they moved in, but obviously that new spouse wasn't an owner of the house from inception of the purchase there. So we'll see how that plays in a role. So yes, you can get the full possible $500,000, but both spouses have to meet the residence requirement. So they both have to live there. Hardship provision. Taxpayers may qualify for a reduced exclusion if the sale was due to a change in the place of employment, health reasons, or other unforeseen circumstances. And then non-qualifying use. The exclusion may be prorated if the property was rented or used for non-qualifying purposes. We'll see examples as well. If you decide to take a year and rent it out, we will prorate the $250,000 or the $500,000, so you get a portion of that rather than not getting anything of it at all. Super important point for the exam, especially when it comes to individual taxation. When we see that we sell a house, we sell our home, we move to another home, don't want to pay tax on that. This is also could be very helpful for you in the future if you are lucky enough to be a homeowner. You sell that home, remember where you learned this here. Come back, say hi to us at examprep.ai. Lots of life beneficial topics as well. All right, we got a nice simpler example here, but we'll obviously get into crazier ones. Then we've got more examples down the line and then multiple choice questions. We've got Jane, a single taxpayer, purchased her primary residence in year 18 for $300,000. She lived in the home continuously until year 23 when she sold it for $550,000. Here's how we can apply the factors to Jane's situation. Well, the principal residence, that it just says it's her primary residence. A lot of times questions will just do that. Awesome, sounds good. Ownership and use test. Jane owned and used the property as her primary residence for 5 years, 60 months, satisfying the 2-year/24-month requirement. And then exclusion limits. Because of all this, as a single taxpayer, Jane can exclude up to $250 of the gain from the sale. $250,000 amount is for single taxpayers. To calculate the gain, subtract the original purchase price from the sale price. So we see that we sold it for $550. Of course, you're going to get slapped with legal fees and real estate agent fees, but that's not a factor for these questions. $550 minus $300 gives us our gain of $250. Now, this is coincidence that it matches up exactly, but because the gain is exactly $250, she can exclude the entire gain from her taxable income. But let's say she had $1 of gain. She had $250,001 of gain. Well, then she'd just pay tax on the $1 of gain. Nothing too crazy, nothing too wild, nothing you can't handle. All right, we got more examples. We're going to see how it's prorated. We're going to see all the nuances and the tricks that you could possibly see. We've got John and Mary, a married couple, filing jointly. That's important because we know that we're dealing with $500,000 of an amount. Purchased a home for $400,000 in year 16. They lived in the home for 3 years, rented it out for 2 years, then moved back in for 1 year before selling it for $700,000 in year 23. Now, in real life, are there probably calculators that tell you how much, you can just find an online calculator to tell you the amount you can take? Yes, but we have to do this the good old-fashioned way, figure it out ourselves. We'll apply all of our factors for the non-qualifying use rule. So the principal residence test, the property was their primary residence during the 4 years they lived in it. The ownership and use test, well, John and Mary owned the property for 6 years, which is 72 months, and used it as their primary residence for a total of 4 years, which is 48 months. Within the 5-year period ending on the date of the sale, they meet the 2-year, 24-month requirement. So we see of the last 5 years up to the sale date, how that works. And then exclusion limits, well, because we're a married filing jointly couple, we can exclude up to $500,000 there. Now, to calculate the gain, it's simply just the selling price, which is $700,000 we see here, minus the $400 purchase price. So that gives us a gain of $300,000. However, we've got a little complication here because we did a little renting and a few other things. So the non-qualifying use, since the property was rented out for 2 years, we have to prorate the gain exclusion. We're not going to be able to take the full $500,000 gain. We're going to take the number of years rented divided by the total number of years owned. So here, that's going to give us 2 years rented divided by 6 years total. That's 1/3 of the whole time. So what is excluded here? We're going to say that the actual exclusion amount will exclude 1/3 of this. So we have a $500,000 maximum exclusion. We're going to multiply that by 1 minus 1/3, and that's going to give us 333. You gotta love that number. Since John and Mary's gain is $300,000, and the prorated exclusion amount is this 333. I don't know, that always gets me whenever you see just numbers that are in sequence like that. They can exclude the entire gain of $300,000 from their taxable income. Note that if their gain had exceeded the prorated exclusion amount, they would have had to pay taxes on the remaining gain. To see how this all works, we change one thing. What happens to our question? Involuntary conversion. What happens if your house gets destroyed, if it gets burglarized, damaged? I mean, gotta love this exam. It's very uplifting for sure. Involuntary conversion refers to the loss or destruction of property due to events beyond the owner's control, such as natural disasters, theft, condemnation. So that could be something you see in a question as well. Let's say there's some chemicals on your property or for some reason, or too much termites, or there's rat feces, stuff like that. The government can come in and condemn your property, say no one can live here, this is for health reasons. Or eminent domain, if you're not familiar with what this is something you can see on the exam. This is when the government decides that your property would be better used in the hands of the government, such as to build a highway. I personally don't think so, but that's up to the government to do whatever they want. There's actually a lot of sad stories of people's houses being taken from them for eminent domain, and then the property is never actually used for anything, even though their house is destroyed. But in some cases, it's beneficial. If there's one house just sitting blocking an entire highway that could potentially significantly help the congestion in the area, then the government can go through a process, get the right to take that property, kind of like in the movie Up, but that wasn't really an eminent domain situation. The government wasn't trying to take his house there. I love that movie. In the context of property taxation, involuntary conversions have specific rules related to gain recognition, reinvestment, and basis calculations. But what happens if you have your property destroyed or essentially converted to possible insurance proceeds involuntarily? So the IRS is, what's the vibe here? The IRS is saying, all right, we know you went through some hardship, so we'll give you some benefits. We'll see what those are. Now, we're going to see that there's no gain recognized if reinvested. So if a taxpayer gets some proceeds from this, such as insurance payouts, if the government chooses to go the eminent domain route, maybe they want to build a bridge and your house is right on the water, so they say, sorry, we're tearing your house down to build a bridge. They legally have to give you the fair value of your home. Obviously, I'd probably try to negotiate with them. They got a pretty big, fat wallet. So if you get proceeds from this, and you reinvest them into a similar or like-kind property, you can defer recognizing the gain for tax purposes. This is known as a Section 1033 exchange. You don't need to know the section. But again, so it's like you get your house taken away by the government, you get some proceeds for that, you go buy a new house, and you can defer that gain. You're not going to, because it was out of your control, you're not going to have to pay tax. These are all tax deferral strategies. Even going back to what we talked about in our first lessons about tax avoidance, tax evasion, all that good stuff, this is the proper way to reduce your taxes. The proper legal way is by using tax deferral strategies that are approved by the IRS, not ones that you made up in your basement. All right, and then reinvestment timeframes. Well, you have, as a taxpayer dealing with personal property, 2 years from the end of the tax year in which the involuntary conversion occurred to reinvest the proceeds in similar property. If you're dealing with business property, let's say your business factory gets destroyed by a hurricane, you get insurance proceeds. You have 3 years from the end of the tax year in which the involuntary conversion occurred to reinvest the proceeds in a similar or like-kind property. Now, I mean, you can totally just take the cash and run with it. Like, not run away to hide to not pay tax on it, but there's nothing stopping you. You're just going to have to pay tax on that. If you get $1 million for the destruction of your property, well, you're just essentially going to take the $1 million minus the value of the property, and that's what you'll pay tax on. Couple other items that we'll keep running through. The basis carries over. If the entire amount received from the involuntary conversion is reinvested, the basis of the new property will generally be the same as the basis of the converted property. This means the taxpayer's original investment in the converted property carries over to the new property. What about partial reinvestment and gain recognition? If the taxpayer chooses to keep a portion of the proceeds, let's say you get a nice fat payout from the insurance company that's maybe in excess of what you really need, or your big mansion you had gets destroyed and you decide, oh, we don't need to use the full money to buy another mansion. We'll buy a smaller house, so we get to keep a portion of the proceeds and not reinvest it. You're going to recognize a gain for that amount, which that makes sense. That's fair. In this case, the basis of the new property is going to be the same as the basis of the old property, adjusted for any gain recognized. Next point here, losses recognized for the full amount. If a taxpayer experiences a loss due to an involuntary conversion, the loss is recognized for the full amount. The basis of the new property in this case will be its fair market value at the time of acquisition. Not too bad. That's just these rules we got to know, and you'll get them done. Very good. Let's move along. We've got an example here for involuntary conversion. Suppose that a business owner's property with an adjusted basis of $200,000 is destroyed by a natural disaster in year 23. The insurance company pays the owner $300,000. All right, not bad, looking good. The owner decides to reinvest the entire amount into a new property in year 24 worth $320,000. Now, since the owner here reinvests the entire amount of the proceeds, the $300,000, received from the involuntary conversion, no gain is recognized. The basis of the new property will carry over from the old property and be $200,000. However, we always like to ask, what happens if you change one thing in the question? If the owner decides to reinvest only $280,000, let's say, and keep the remaining $20,000, they must recognize a gain of $20,000. In this case, the basis of the new property would be the same as the basis of the old property, adjusted for the recognized gain. So the new property's basis would be calculated as follows. We'd have the old property's basis plus the recognized gain, because we don't want double taxation on that. By adding the $20,000 to the basis, because we pay tax on a gain of $20,000, we won't pay tax again on that additional $20,000. That's the concept of having to pay tax once and not having double taxation throughout these transactions. Nice recap on involuntary conversion. Well, these rules in property taxation allow taxpayers to defer gain recognition if they reinvest the proceeds. You're being a good taxpayer, good American business person, if they reinvest the proceeds into similar or like-kind property within the specified timeframes. The basis of the new property generally carries over from the old, with adjustments made for any recognized gain or loss. Now, if the taxpayer chooses not to reinvest the entire proceeds received, they must recognize a gain for the amount not reinvested, as we saw, and the basis of the new property will be adjusted accordingly. Losses due to involuntary conversion are recognized for the full amount, and the basis of the new property, in this case, will be its fair market value at the time of acquisition. Here are some miscellaneous points about the disposition of assets. For any divorce property settlements, we have assets being divided between the spouses. The transfer of property between spouses or ex-spouses as a part of a divorce settlement, this is generally not a taxable event. The recipient of the property takes a carryover basis, meaning they assume the same basis as the transferring spouse had in the property. Whether it's spouses in divorce or just spouses in general, when you transfer between spouses, it's not going to be taxable. Generally, this is just because the IRS views you as one entity, married filing jointly, right? So you're just transferring assets between essentially the same person. That's how they view it. So that's just a good way to remember it. Installment sales. In installment sales, the seller receives payment over time. The gain or loss on the sale is taxed as the payments are received based on the proportion of the gain or loss relative to sale price. And then treasury and capital stock transactions. Gains and losses from transactions involving U.S. Treasury securities or a corporation's own capital stock are generally not recognized for tax purposes. So a few points that some we do go into further elaboration on with some questions. Some we will not, just depends on the importance. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.